Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? My guest today is Dr. William White. He is a veteran journeyman of the central banking world. He is a Canadian economist who began his career as an economist at the Bank of England, the Central Bank of the United Kingdom. He was also at the Bank of International Settlements. In fact, he had the job that my recent guest, Claudio Borio, now has as head of the Monetary and Economic Department at the BIS. He was also deputy governor at the Bank of Canada, and he was chairman of the Economic and Development Review Committee at the Organization for Economic Cooperation and Development, the OECD, from 2009 to 2018. So he's been around. He's seen a lot. He's someone that I've wanted on the program for a very long time. We've been in touch for about a year. I've been trying to schedule it to do it in person with him when he would be next in New York, but it proved difficult, and I just elected for us to do it remotely. And I'm glad I did because it was a phenomenal conversation. I think the overtime went for about 40 minutes. I literally just finished the recording now. We talked about so much. We talked about reordering of the global financial system. We discussed the way in which the system has changed since 2008, both on the regulatory front, driven by changes in regulations, but also non-regulatory changes, and how that has altered this complex dynamic system, this organism that is the global financial system. Before I let you guys have a listen to the conversation, I want to make an appeal. I mentioned that the overtime was something around 40 minutes. Overtimes can vary. They're usually around 30 minutes long, but I put a lot of effort, and my guests make the effort to make themselves available to do these overtimes, and I do it because I want to be able to give you guys something that is valuable in return for your support. Because, of course, the people that are paying $10 a month for the audiophile subscription aren't doing it just because of the overtime. They're doing it also to support the show, and I'm incredibly appreciative of that. And you don't have to support the show every single month. There is no long-term commitment. You can do it for just 1 month if you want to, and even try it out. That'll give you access to the entire library of overtime content, and you get a link from Patreon that you can use on your phone, on your favorite podcasting application, and you can get the overtime just like you get the full episodes. So I think it's more than worth it. And I think there are many people who feel the same way about the transcripts as well as the rundowns. And the rundown to this week's episode is phenomenal. And I would strongly suggest those of you who are already subscribers to the audiophile or to the autodidact subscription to try the Super Nerd subscription out and gain access to these rundowns, because I put a tremendous amount of time and effort into them. I also make PDFs available of papers and articles that I rely upon for the research for these conversations. So it's kind of like you're getting access to my desk. And I think that for many people, that's worthwhile. But the larger point is that you're helping to support the program. I have had conversations with sponsors, I will tell you this honestly, for probably close to 2 years now, about 6 months into when I started the program, and I've consistently turned down those opportunities. That has become more and more difficult to do because the show has become so popular that the offers are increasingly difficult to turn down. But I'm still at a place where I haven't accepted any sponsors, and ideally, I'd like not to have to do that. That may not be possible, but at the very least, having a base of subscribers that cover the fundamental costs of the program will allow me to, at the very least, be very choosy with who I bring on as a sponsor, not have to rely on many sponsors, perhaps only one, no mid-rolls, but also it means that I don't have to feel beholden to anyone. I don't have to worry about losing my sponsors because I know that the costs of the program are covered. And if you want to support the program, I've tried to make it as easy as possible. I've put a link in the description to this podcast, as I put in all my previous podcasts, that links directly to our Patreon page, which is patreon.com/hidden forces, where you can go and sign up and get access to the RSS link for the overtime, as well as a transcript to this week's episode, as well as access to this and every other single rundown we've ever put out. And now, without any further ado, here is my conversation with economist and former Deputy Governor of the Bank of Canada, Dr. William White. Dr. William White, welcome to Hidden Forces.
Well, it's great to be here.
It is so exciting having you on. I think we've been in touch for about a year now. We were trying to make this happen in person because you know how much I love doing these things in person. But on account of the fact that has proven difficult and because I really wanted to have you on, we've decided to do it remotely. Also, for listeners, I'm going to assume that you have knowledge of our episode with Claudio Borio, which was recently. I think that was episode 99. I'm going to assume you've listened to that. If you haven't, I suggest you go back and listen to it before this episode because it's going to be very helpful in this conversation. Dr. White, Bill, as I was saying to you, I've done an enormous amount of research for this episode, even more than I normally do. And I would love to kind of begin with a general structure to answer the question of where are we today, after 10 years of recovery since the great financial crisis. How has that system, the financial system, this dynamic organism, how has it evolved? How has it changed? How have regulations changed it? And what have been perhaps some of the non-regulatory forces that have acted upon it? And what are we likely to see going forward, not just from the system itself, but let's say the actions of policymakers? And we're going to talk about all of that as we go forward. I have all those questions, but I kind of wanted to put that out there. But maybe you can start us off with where you think we are today.
Well, insofar as the economy is concerned, guess what I'm concerned about is that we're not really in a very good place. The problem, I think, that was underlying the crisis that broke out in 2008 really was a problem of excessive debt accumulation that had been stoked up really by central banks, an overly expansionary banking system. Well, since the crisis, the 10 years since, one might have thought, after you get into these boom-bust cycles, that we went through the boom phase and then you go through the bust phase. The former, of course, has a big increase in credit and debt and the rest of it relative to the size of the economy. You would have thought in the bust phase that you then go back into the deleveraging phase, so that the problems that built up during the boom would be rectified during the bust. But the very opposite is true. What has really happened here over the course of the last 10 years is that global debt ratios, and by that I mean sort of the sum of government debt, household debt, and corporate debt, the ratio of that debt to global GDP is actually up by 30 or 40 percentage points of GDP. So we're way off a process of deleveraging and restructuring. In effect, it's been more of the same. So if there were problems that emerged in 2008 because of debt and other imbalances in the global economy, I dare say those problems are even bigger today than they were then. So that's something that sort of bothers me, sort of looking forward.
So what's the source of those problems? What was it that led to 2008, and how many of those forces are still pushing us in a similar direction, right? And I'd also wonder what has been done in the years since to try and change that? What efforts have been made?
Well, what sort of got us into the situation, it seemed to me, was the confluence of three good things. But when you put those three good things together, they produced a bad thing. Now, let me expand on that. The whole period, really sort of 15, 20 years prior to the crisis, was characterized by a number of very positive supply side shocks. And what I mean by that was that the global capacity of the economy to produce things went up pretty sharply. And that was really due to two factors. I mean, one of them was the demographics, the baby boomers coming through in the advanced market economies. But the other thing was the return to the global trading system of China, India, and all those other command and control economies. So we had a huge positive supply side shock that basically drove down prices or increased disinflationary forces in the economy. Now, that was a good thing in itself. But the second thing that happened was that the central bankers had really, since the middle of the 1990s, become more and more focused on establishing stable prices. And so what that meant was that with the real side changes leading to prices starting to decline, the central bankers felt that it was their duty, if they were going to maintain stable prices, to lean against that, which of course they did by relatively easy monetary policy. Then the third thing that came along was, again, one could say another sort of good thing, which was there was deregulation in the financial system. There was huge amounts of innovation in the financial system, all sorts of new products, new services, new sources of credit. And one might have said, well, that's a good thing too. But then when you put all three of them together, what you wound up with was the disinflationary forces coming out of the real side led to the central banks to conduct relatively easy monetary policies for long periods of time. They never had to raise rates very much, and they could lower rates whenever the economy slowed down because inflation was not a problem. Well, they did that, but then with the sort of the good news in the financial system that it was becoming more efficient, deregulated, etc., they were prepared in the financial system to provide the credit, to supply the credit that was now in high demand because of the influence of ultra-easy monetary policy. So when you put these three good things together, what you wound up with was enormous forces towards increasing credit growth, increasing debt levels, and basically leading to all of the other imbalances, which in the end both contributed to precipitating the crisis and leading to it being as deep as it was. So this gets you back to sort of something I'm quite fond of, which is the theory of complexity, which is that in these complex adaptive systems, and I would include the global economy, it's the characteristics of the system that are really important, as opposed to the characteristics of the individual bits that comprise the system. And here we had three goods adding up to a very big bad.
I want to talk about that. We've done a number of episodes on complexity theory going all the way back to our episode with Brian Arthur. I think that was episode 9 or 8, actually. But you also talk about Keynes. You quote Keynes a lot, and you quote some of the older economic thinkers back when economics was political economy. Two questions. One is, how much of a change have you seen in terms of integrating these models from alternative disciplines into economics since the crisis? Behavioral economics, for example, or complex dynamic systems research. And then also, how much has there been a look backwards to see what people were using, how people were thinking about the economy before the end of World War II?
Well, I think it depends on where you're looking. I mean, I would have thought the standard economic models, the kind that they teach in sort of most undergraduate and graduate courses, sort of called real business cycle models or dynamic stochastic general equilibrium models. These models basically assume that the economy has got very strong equilibrating properties, so that if it's hit by a shock, which is basically what causes problems in those sorts of models, the assumption of exogenous shocks, the economy sort of, as it were, sort of absorbs the shock and then it very quickly goes back to full employment or back to equilibrium again. And I guess I would have thought, given that the crisis that we had in 2009 and 10, to say nothing of Europe in 2010, given that the models basically rule that out as being impossible, okay, when they saw the reality, I would have thought there would have been a much greater tendency to say, the model is inconsistent with what has actually happened, and therefore I'll rethink my model. But as it turns out, there really doesn't appear to have been all that much change at the level of academic inquiry. Now, having said that, apparently, and I'm not in the academic community, apparently a lot of the younger people are starting to delve into this in a rather more serious way. The serious analytical thinking, it seems to me, where one says, let's start thinking about the economy not as a kind of controllable, understandable machine that can be reduced to its component parts, but let's think about it as a complex adaptive system that is constantly evolving and has all the properties of a complex adaptive system. That kind of thinking is taking place, it seems to me, mostly outside the academic community. Now, I could be wrong here, but I've just come back, for example, from a 2-day conference at the OECD, where they have a big program which is called NIAC, New Approaches to Economic Challenges. And the specific title of this conference was Averting Systemic Collapse. And those people at the OECD, in association with groups like INET and associations concerned with complex adaptive systems, they're the ones that are sort of doing most of the thinking, but it's by no means mainstream, even 10 years after the event. And as for looking back to history, there's a great book, I think it's David Simpson, who's a professor emeritus at Sterling, and it's called The Rediscovery of Classical Economics. And basically, what he does is he reminds us that the classical economists, I'm thinking now, Malthus and Ricardo and Mill and Adam Smith and all those folks, that they were really concerned about 3 major issues. And one of them was the origins of growth, where does it come from? The second one was the question of crises and where do they come from, because they suffered them in those days as well. And the third issue that they were concerned about were distributional issues. Marx and the limit, class war, rentiers versus the others. Well, in sort of modern economics over the course of the last 20 or 30 years, everything sort of boiled down to growth. And questions having to do with crises and sustainability and distributional issues just sort of disappeared. And I think it's unfortunate that that happened. And I think it's very important that we go back and that we start thinking more seriously about these issues of system sustainability, system resilience, and the distributional implications of the policies that we follow. And I think that's starting, but it's by no means progressed as much as I think it should have done, given that we're 10 years after the crisis.
I think one of the interesting observations that you've made, and I share it, is that we live in a world where we feel extremely uncomfortable with uncertainty. There's no clear way to sort of grapple with that, and we expect certain answers from our elected officials or policymakers. And I wonder to what extent the certainty that the model provides within the framework of the model is traded for its effectiveness. And I think you've also mentioned the work of Daniel Kahneman, the fact that people, when a crisis occurs and it's so unforeseen, that they tend to dig in. They tend to retreat to their models rather than question them. So that kind of makes me think, to ask you the question, what did policymakers ask themselves when the crisis happened, or let's say once they got through the firefighting phase of it? What were the questions that they asked when they began to try and introduce regulations to try and prevent this from happening?
Well, I'll be honest, Demetri, I left in 2008, left that community in 2008. So I've not been sitting around the table with these men and women in the intervening decade. So I'm probably ill-prepared to answer that question. But one of the things that has struck me is that the policies that have been followed on the monetary policy side have essentially been more of the same policies that were followed before. So in a sense, one has to conclude, one doesn't have to logically, but one's tempted to conclude that the underlying analytical framework has not changed very much either, because the policies that they've been following have been the same sort of crisis as they were pre-crisis. And those policies basically said, we're going to have very easy monetary policy. I've described it elsewhere as ultra easy monetary policy. Zero interest rates, negative interest rates, forward guidance, quantitative easing, all of that stuff. And they've done this given two beliefs, which I think preceded the crisis. One belief being that monetary easing will be effective in restoring aggregate demand, full employment, and a return to potential growth. The second belief is that these policies do not have unintended consequences of any magnitude, and particularly don't have undesirable consequences of any magnitude. And I guess my sense is that both of those beliefs are wrong. Now, whether people have been inside the central banking circles thinking about that particular range of territory, I don't know. One of the problems, and I've wrestled with this over the course of the years, one of the reasons why central banks have done what they've done could be because they believe what I have just stated that they believe. The other, more charitable response is that they've actually been sort of trapped by governments who should have done certain things to help sort these post-crisis problems out, but who didn't do those things. So the central bankers sort of, lowered interest rates, and they did what they did in the immediate aftermath of the crisis. And I think what they did was spot on, absolutely right, probably saved us from another Great Depression. But I think if they were then thinking about the possibility of renormalizing policy pretty quickly, they found themselves confronted with the fact that fiscal policy, which had also been sort of eased, in the 2009 and 2010 period, went sharply into reverse. It became significantly contractionary. And then we get into all the regulatory stuff. So the financial regulators put rather less emphasis on trying to clean up the damage, the financial damage from the crisis itself, and they put rather more emphasis on measures to prevent a recurrence of the crisis. But what that essentially meant was that regulatory policy, both microprudential and macroprudential, was also basically constraining aggregate demand. So there's the poor central bankers finding themselves in a situation where they've followed the right policies, they've got ultra-easy monetary policy, they want to renormalize, but they're the only game in town because everybody else is moving in the opposite direction. Now, I suspect that both of these things may have played out in different ways at different central banks, that, some of them have done what they've done over the course of the last 10 years because they really believed it would work and it would have no side effects. Others basically said, I'm waiting for the government to do what they should do, but it's not happening, so I just have to continue doing what I have done. I'm sort of caught in a kind of trap. Now, so that's sort of what I suspect has been going on.
So a lot of things there. One, let me ask you about your point about the fiscal side. What do you think needed to be done in the years after the crisis on the fiscal side in order to address what I assume was the buildup of large amounts of private sector liabilities that we discussed earlier? What do you think should have happened?
Well, I guess in retrospect, and I'll be honest with you, I wish I'd seen things as clearly then as I do now. As I mentioned earlier on, there was, in fact, a sharp expansion of fiscal policy, I think, in 2009 and 2010. And then there was an equally sharp movement to really cut the fiscal deficits. And we saw this in a lot of places, not least in Europe, but also in many other countries as well. I think in retrospect, it would have been better to have maintained the expansionary fiscal policy and allowed some room for monetary policy to renormalize at an earlier stage. But I think the focus at the time was on the fact that most governments, even then, had large debt ratios relative to where governments felt comfortable with. And so when people started suggesting after the Greek crisis that everybody could turn into Greece, there was this kind of wholesale movement towards austerity. And I think actually that was a mistake. And I think looking forward here, although it's unfortunate because perhaps some countries are less well placed to have fiscal expansion now than they were earlier, I think that looking forward, when we think about the possibility at least of a further downturn, that there will have to be more reliance on fiscal policy. But I would say this, in the same sort of way that the private sector has got debt levels that I think are sort of unhealthily high, nobody would suggest that the big countries, at least, are all in a very good fiscal position. So if they are going to do more on the fiscal side by way of expansion going forward, should the economy slow down significantly, I would really like to see that allied with a promise, a credible promise somehow, that the governments would ensure that going forward, that there would be a tightening of fiscal policy during good times that would be as robust as the easing of fiscal policy in bad times. And that's something that we didn't have in the past. So that whenever we had bad times, fiscal deficits generally got much larger. But then when the good times rolled around afterwards, the degree of tightening was never symmetrical. So the upshot was that cycle after cycle, we've had government debt ratios ratcheting up cycle after cycle in exactly the same way as the interest rates have been ratcheting down cycle after cycle. That's sort of where I think we have been with respect to fiscal policy and where I think we might be going with respect to fiscal policy.
So do you feel that the growth in debt, the increased reliance on debt in order to fuel economic growth, is a result of the political forces of our Western liberal democratic systems and the demographics as well? And what do you attribute it to, the fact that we've had to rely, we've seen this major growth? A lot of people would say we'll focus on one particular thing. They might look at going off the gold standard. They might look at the deregulation of the financial system in the 80s. How do you think about this?
Well, I think that the reliance on debt, I mean, this is something really that sort of started after the Volcker years. Okay, it's really sort of a product of the last 20, 30 years, I suppose. In large part, I think it's because of the fact that monetary policy encouraged the buildup of debt. I mean, in a sense, when you think about how monetary policy works, you know, you lower interest rates and you induce people to bring forward the spending that they might be doing later, bring it forward to today. But the vehicle through which they do that is borrowing in order to get the finance to be able to do the spending today as opposed to later. So that sort of, the debt thing comes with the territory of easy money.
Is it also reflection or commentary on something you mentioned earlier, which has to do with the focus, the maniacal focus, as I said in my episode with Claudio Borio, on inflation, on consumer price inflation or producer price inflation, and the fact that the 1990s was a period where we opened up our economy. The United States was able to import, and other Western countries were able to import cheap goods from Asia. That kept inflation low, and central bankers focused on that inflation number and perhaps kept interest rates below the natural rate for years, and that this has been a large contributor to the deflationary circumstances that we now find ourselves in today.
Well, yes, this gets back to the sort of the initial description that I gave earlier on about how the system got out of whack, even though the various bits of the system were actually moving in a direction that seemed to be more, quote unquote, efficient. So yeah, the very low inflation coming in from globalization and the demographics, the baby boom, etc., really lay the foundations, as it were, trying to back in the demand through easy monetary policy, in the process and inadvertently building up these debt levels. And over time, of course, as the debt levels build up, as one might, common sense tells you, as the debt levels build up, the capacity of monetary policy to induce still more spending based on still more debt becomes less effective. So I think that's been one big force. Another big force for the credit increase in some countries at least, has been the fact that the income that has been generated has been so unevenly distributed. So, we've had this business about the top, 0.1 of 1%, etc. Raghu Rajan, in a book that came out a number of years ago, makes the point, I think he's quite right, that a lot of people observing what the Joneses were doing, i.e. the people that were getting the income from the growth in the economy, wanting to keep up with them, found that borrowing was a reasonable alternative, at least for a period of time. And of course, with the deregulation in the financial system was more than pleased to supply the credit that people were demanding in order to keep up with the Joneses, and they were able to get access to it at relatively low interest rates. So it was a combination, I think, of all of those things.
So I suggest also for listeners to listen to our episode 83 with Raghuram Rajan. I also want to take a quote that you've mentioned before. It's from the general theory. Again, it goes back to my point that it feels, in fact, I don't think I made this particular point, but it does feel to me that there is a reductive, simplistic interpretation of Keynes in particular. But generally speaking, there seems to be a willingness by people to assume that they understand certain economists or thinkers without actually having read their work. There's a great quote by Keynes. I'm going to say it now, and it relates to your point about the ineffectiveness of monetary policy in the face of large amounts of debt. It's not exactly the point he was making, but it's relevant. This is the quote. If, however, we are tempted to assert that money is the drink which stimulates the system to activity, we must remind ourselves that there may be several slips between the cup and the lip. Now, this isn't, I suppose, exactly a slip, but I think the mechanism of monetary policy, that process between the cup and the lip, becomes less and less effective in a system that's overburdened with debt. And you made the point that interest rates are effectively a way of pulling spending forward from the future into the present. But if we assume that spending isn't infinite, that future spending isn't infinite, then at what point does tomorrow become today? In other words, at what point does this no longer become effective, that the interest rate mechanism is broken as a tool for stimulating the economy? And is it possible that that's kind of where we are today?
Well, I think what we've observed over the course of the last 10 years is that monetary policy has not been anywhere near as effective as people had anticipated it would be. And one way of indicating that that's so is that I think the IMF, the OECD, the Fed, and virtually all of the major central banks have, I think with the exception of last year, in every year since the crisis, their forecast for next year has been growth that in effect turned out to be substantially greater than what actually materialized. And their forecasts for inflation have been almost exactly the same. The forecast has been for a increase in inflation back to the target levels. And in fact, year after year after year, they've failed to meet those objectives. And to me, what this says is that monetary policy has been losing its effectiveness, exactly as that quote from Keynes seems to indicate. It has been losing its effectiveness. And if we would attempt to go back and do it all over again, although I'm sort of asking myself, what precisely does that mean in a world where interest rates are already negative on $16 trillion worth of government bonds, et cetera, et cetera. Okay, if we were to try to do again what we did the last time around and it were possible, would it work at all? And I'm actually pretty skeptical. And I think, in fact, that skepticism is now gradually kind of affecting many other people. And so we're hearing more and more people say, well, reluctantly, well, maybe this time we'll have to rely more on fiscal policy. And I think implicitly what they're saying is they know that the game is over on the monetary policy side.
So I do want to dig into that deeper. I want to mention something that you said in an episode with a mutual friend of ours, Grant Williams, which I think he actually reiterated in an episode that we did together, which was using a metaphor. In fact, I actually got in trouble for this. Some people apparently took it literally because the title of the episode with Grant Williams was something to do with quantum mechanics. But you used quantum theory as a great metaphor for talking about how the way that we understand physical systems changes at the quantum level, that behavior changes from what we expect traditionally with Newtonian models, and that there's this assumption that seems to exist in the economics profession that the way it works is just take it lower, just take the interest rates lower, just keep going low. And if you go below zero, it doesn't matter. It's just lower. What's the difference between 0 and -1 versus 1 and 0 if it's both just 1 or 100 basis points lower? Can you give us your sense? Talk to us a little bit about what does it mean to live in a negative rate world, and why do so many of us struggle to understand how that would work?
Well, I'm still struggling to understand how it works. I remember I was in Switzerland at the time when some of the European central banks went to negative interest rates on reserves. And again, I think you're quite right, Demetri, in suggesting that in a sense, it was nothing more than a kind of linear extrapolation that if 2% interest rates are more expansionary than 3% interest rates, and 1% is still more expansionary, et cetera, et cetera, et cetera. But the first thing that struck me, and I think it happened within days of the Swiss National Bank bringing in negative interest rates on reserves held by the banks, is I think it was Credit Suisse raised the mortgage rate. Okay? Now, this is not in keeping with the linear extrapolation, but when you think about it, the logic is perfectly straightforward. And there's also a discussion of this in the general theory, by the way. Banks have to make profits. And so if you're going to charge them for the reserves that they're holding, somehow they've got to get the money back to maintain the profit level. You'd say, well, why don't you have negative rates on deposits? They're very loath to do that because their customers will hate them for it. So the only other place to go is either start raising fees in lieu of increasing loan rates or raising the loan rates, which is precisely what Credit Suisse did. So the fact that the banks are there as intermediaries who have to be profit-making intermediaries changes the model in a significant way. Again, I mean, I think in the early days, not much consideration was given to that. And I guess the banks were making enough money that they managed to sort of get through the early years of the post-crisis period without complaining too much. But really, these ultra-easy monetary policies have been a source of great concern to pension funds and insurance companies almost since the whole policy began. I mean, these people, threatened, as it were, by demographics, climate change, and whatever, fintech, all these other, threats to their business model, now find themselves having to cope with these very, very low interest rates on the assets that they hold. As you know, increasingly, the banks have been very worried about it and have been expressing their worry about it. And we're hearing sort of more and more rumors that maybe if they do decide to do a higher number for the negative interest rate on bank reserves, that they'll try to tier the reserves in such a way that the banks won't have to bear the full burden. So some of the realities here are starting to filter through, but it does seem to me that it took a long time for that to happen. But again, it goes back to what I was saying right at the beginning, is that there's this tendency to think about everything in sort of simple, linear terms, when the world isn't simple, it's complex, and it's not linear, it's highly nonlinear. I think that really is the fundamental analytical point that we have to grasp. But as I said earlier on in this conversation, I don't think we're there yet. The paradigm shift is not yet occurring.
Well, I think also an interesting observation is also, to your point about the system being complex, is that, for example, if we lived in a world where people were 20 years on average younger, perhaps lowering interest rates would cause them to speculate more in asset markets. But you can imagine a world where people are older, that their risk appetite has dropped substantially. And so if you lower interest rates, they're going to just end up saving more.
Well, I actually did a piece back in 2012, I think, which was published by the Dallas Fed. And it was called Ultra Easy Monetary Policy and the Law of Unintended Consequences. And through it, I mean, there was a big section in there about why it's back to the quote from Keynes, why monetary policy was likely to be ineffective. And one of the points I made was the point I made earlier, that you're just bringing spending from tomorrow to today. And I mean, obviously that's a short-term thing. It can't go on for all that long, because then tomorrow is today. But in addition, I sort of went through the individual components of spending. And on the household savings side, you're absolutely right that if you've got a demographic bulge with older people who are close to retirement and who are saving, let's say, for an annuity so that they lead a reasonable life in retirement, if the roll-up rate on their savings goes down, then they've got no choice other than to work longer, which of course many people are. They have to save more. And so what you get is the very opposite of what you intended. And there's distributional issues as well. I mean, if the low interest rates are basically hurting people who've got a high marginal propensity to consume, well, then that's also counterproductive. And in the investment side, again, in this paper, I run through a lot of things, but something that I've become more and more concerned about is the interaction between easy monetary policies and management compensation schemes. And there's a friend of mine, Andrew Smithers, actually, who's just he's been saying this for years, but he just published a book on it. And the logic is actually pretty simple, which is you've got the management whose options depend upon the price of the shares. And so for them, it's sort of a no-brainer to sort of use easy monetary conditions and very low interest rates to borrow the money, which they then use to buy back the shares or pay out in dividends. This pushes up the share price, pushes up their bonus. The smart shareholders are prepared to sell because they know that the shares are being bought in at an inappropriately high price. And so in the end, what you wind up with is these corporations that are gradually being eaten away. And of course, there's no investment either, because investment is a drain on cash flow, okay, and depreciation and all that stuff. So you cut investment as well in order to use the money to buy back the shares. So you get into a situation where everything looks good, but the corporation is actually being hollowed out and no investment is being done. And to me, that seems a lot like what we're actually observing. So not so effective.
So I want to continue on this larger point you've made a number of times, which is unintended consequences. You said part of the titles of the paper that you cited was Ultra Easy Monetary Policy and the Law of Unintended Consequences, which I believe you published in August of 2012. It was one of the papers that I read in preparing for this conversation. There are, of course, unintended consequences that occur from regulation. And one of the ones that we've heard a bit about has to do with liquidity. We might have seen something to this effect recently in the repo market, but I wonder, to what extent is that a concern, do you think? Let's say the capital requirements that were put in place with Basel III, first of all, were they stringent enough? And the second question is, in the current environment, given what we've discussed in terms of the impairment of the financial system, could those requirements actually create illiquidity at a time when the system needs it the most?
Well, there is a lot of concern out there. The Treasury market, from what I've read, the standard sort of measures of liquidity, turnover, spreads, etc., don't seem to be affected all that much. But apparently in many other markets, the degree of liquidity is much reduced from what we had before. And certainly one of the reasons that is contributing to that, I'm sure not the only one, is that the people that used to be market makers, the big banks and the investment houses, etc., because of the capital requirements for doing that, they're now keeping a much, much smaller inventory of bonds and assets of that nature. And so the upshot is that they're not really in a position to make the markets in the way that they did before. And in part, that's an unintended consequence of the regulation. But I think I recall reading not so long ago, this was Mark Carney's letter as chairman of the FSB, his letter to the G20. that I think they explicitly recognized this as a potential issue that they were going to be looking into. And I thought that was a positive step.
Well, I also, the way that the Fed manages, I guess, like maybe it's not precisely the way they manage liquidity, but I think the Fed used to be, and you're in a position to enlighten me on this, and central banks in general used to be more active in the market with open market operations in order to manage interest rates in the range that they wanted. It seems now they've relied much more on tools like forward guidance and IOER, interest on excess reserves, and that perhaps part of what we saw recently in the repo market is just a reflection of the fact that they're draining reserves from the system. And also, do you think on some level there is, I've talked about it in terms of a loss of sensitivity, and this goes back to the point about how the system has changed, that market participants are just used to, in this marketplace, things being kept low vol, right? I mean, specifically, their short vol strategies have exploded during this period. But do you think that there's less discrimination, that maybe perhaps market participants have lost some skill in price discrimination in this market today after 10 years of these policies?
Well, yes, I do. I mean, in terms of markets more generally, I think the fact that there's been so little volatility in so many of these markets, to me at least, implies that the process of price discovery, which is where the market has to make up its own mind, what's a fair price, that perhaps the capacity to do that after 10 years of the central banks essentially setting the price for most of these assets has sort of atrophied a bit. So yes, that would be a worry. In terms of the recent thing in the repo market, again, I don't profess to be an expert in that particular area compared to some of the folks that are out there that really do understand. But I guess one of the things that does strike me is that there have been pressures on the supply side of reserves, so that the Treasury's been issuing an awful lot of debt and then sort of sitting on it in its assets as it's trying to increase its reserves at the Federal Reserve. So that's the sort of the supply side. But the thing that sort of, again, I don't know much about this, but worries me a bit is on the demand side. And that maybe what we're seeing here is a little bit like what we saw at the beginning of the crisis in 2008, which is that the interbank market essentially dried up. And in part, it was because people who had the reserves, the swings and the roundabouts, they wound up getting sort of the reserves. But instead of then lending them out to the others, they basically decided to sit on them because they weren't convinced really of the soundness of the counterparty to whom they might be lending the reserves. So this is another sort of area that I think people are starting to look into. But there's little question that the way in which the system operates is quite different from the way that it used to operate prior to the crisis, largely because the excess reserve levels are so high relative to where they were previously.
So I think you're kind of referring to the daisy chain phenomenon that happened, which was part of the contributor for the freezing up of money markets around the time of Lehman. There were a lot of off-balance sheet entities that were being used by banks at that time. I think you've written about this. That has largely gone away, I believe. So how do you think the system has changed both through regulation and organically for the better since the crisis? And then maybe we can talk a little bit about the areas that concern you most, some of which we already mentioned. But where have you seen an improvement?
Well, the improvement in terms of the regulatory regime, is pretty clear. The capital levels for the big banks are much higher than they were before. Liquidity levels are higher than they were before. On the particular complication posed by those sort of sieves and conduits that, were allied with the banks in the pre-crisis and immediate post-crisis period, the FSB did a study into shadow banks here quite recently. And my recollection was that they concluded that that particular problem basically was no longer a problem, that this daisy chain sort of set of arrangements had basically been put to rest. But what they did sort of note, and I think lots of others have noted too, is that as the regulations on the banks have tightened and on those entities that were problems before have tightened, that the money has basically just gone someplace else. And this is what I think Charles Goodhart often refers to as the boundary problem. That you tighten up the regulation in one area and then the money just sort of moves. So what has happened, there have been all sorts of things, but one of the things that happened, of course, has been this huge expansion in asset management companies. And that's an area which is essentially less heavily regulated than the newly regulated banking system. So then the question arises, what will be the behavior when times get tough of those particular kinds of financial institutions? And they don't need a lot of capital because they don't have much skin in the game. But the reality is that if their customers, let's say in the mutual funds, decide to take their money out and do something else with it, then there will have to be some kind of a reaction on the part of these firms. And the answer is, what will the reaction be? Will it involve fire sales? What are the implications for emerging markets? There's a lot of issues for which I guess we have no clear answer at the moment. All we can point out is that the system is different today from what it was 10 years ago.
So you mentioned emerging markets. You've mentioned that before. Emerging markets were part of the solution in 2008. China, I think, grew domestic credit by an average of about 20% per year in the first 6 or 7 years after the onset of the crisis in order to boost growth. And of course, a lot of these other countries that are part of the supply chains benefited from that. And of course, all of these emerging market economies also benefited from the carry trade and from the expansion of U.S. monetary policy, which perhaps brings us into a larger conversation about reforming the global financial system. But what is the concern now with emerging markets? Are they now perhaps on the hook in the way that we were 10 years ago?
Well, I think the answer is yes. As I mentioned at the beginning of this discussion, global debt ratios, debt to G&E, global G&E are way up. And where they've risen particularly noticeably has been in the corporate sector of emerging markets, particularly China. But my recollection, not limited to China, there's a number of countries that have seen their debt levels, corporate debt levels in particular, go up pretty high. And the worries are of many sorts. I mean, one of them is that just the debt levels themselves may be a threat to the survival of the corporation if the money hasn't been used for good purposes. The other concern is really to do with the currency in which many of these loans have been taken out. So a lot of the corporate borrowing in the emerging market economies has been done in dollars. And the concern would be that for whatever reason, let's say if you had a crisis where, sort of a global crisis where all of a sudden it was risk off again and everybody was piling into US dollars as a safe haven, then the dollar goes up, at least relative to these emerging market currencies. And then the debt servicing requirement for these people who don't actually earn most of their money in dollars is obviously bigger than it would otherwise be, which just aggravates the counterparty problem. So that is a concern. Just a few days ago, I think McKinsey Global Institute published a piece that basically talked about the Asian financial system and raised a number of concerns. And again, it's back to, this kind of stuff that in a sense we saw during the Asian crisis, which is that if the borrowers have got problems, run into problems of the sort that I've just described, then the lenders, which would include domestic lenders as well as international lenders, they might find themselves in some trouble too. And McKinsey seems to be concerned about that at the moment. So I think you said it earlier on that in 2009, the emerging markets were part of the solution, particularly China, with the rapid expansion of credit and, loans there. But now they're part of the problem.
So let's actually talk a little bit more about that. I read a book when I was in college. It had been published years earlier called The Crisis of Global Capitalism. It was by George Soros. And there was also a documentary that came out around the time that I was in college, or maybe it came out earlier during that period in the late 90s, but I saw it some years later, called The Commanding Heights, and I think it was based off of a book.
Oh, I remember that. Yeah. It was a TV series. I think it was BBC.
Is that right?
I think.
I actually watched it while I was living in Italy. I was studying in Italy as a foreign exchange student, and we had a very progressive economist doing some class on economic development. I can't remember. It's actually really interesting to study economics in different parts of the world. There's a difference in how it's taught, and I think it's a way it's useful to get those different perspectives. But Soros's book really stuck on me. His message, I mean, that was the first time I heard him extrapolate his theory on reflexivity, which he got from Karl Popper. But that's the first time I also learned really about the dollar carry trade and the power of the dollar and these hot money flows. And this is sort of a way of, again, bringing it back to the question of how did we get here? And I wonder, for someone like you who has, I think you began your career when, in the 70s? Did you start working in central banking?
Oh, gee, in the 60s. I hate to say it, but it's true.
So the 60s, wonderful. That makes you even more
old than you thought.
Great. Well, so in fact, you've actually worked in the field when we had fixed exchange rates, when we were under the Bretton Woods fixed exchange rate system. And you experienced what the world was like before 1971 and 73 and after. And that system was architected very deliberately. But the system, it seems to me, and this is sort of a question, right? I'm not making a statement. I'm making it without a question mark, but it's a question. The system that we have today, on the other hand, doesn't seem to have been very well architected. It just kind of emerged out of the end of Bretton Woods, maybe the late 70s, and that's really what the deregulation was. It was an attempt to grapple with this new system on the fly. Does that resonate, that that's sort of the system that we're living in today, something that was sort of just kind of came out of what ended without a really clear plan?
Yeah, I would certainly agree with you on that front. I think that people have cobbled responses together to various problems. But really, since the breakdown of Bretton Woods, there's been no concerted attempt to rethink the system. And that sort of worries me, because I think what we do have, and others have referred to this as well, Robert Pringle and others, we have a none system. It just sort of is what it is, and anybody can do whatever they want, whenever they want, without any form of external discipline being imposed upon them. And I think that's sort of worrisome, not least because I think, there's all this attention at the moment to trade wars. I would contend that we've been in a kind of hidden currency war for about a decade. That, when the Fed first started doing all of this sort of quantitative whatever and started pushing the value of the dollar down, there were all sorts of other countries who didn't want to see the value of their currencies go up for exactly the same reason as the Fed was easing, because they also faced problems of high unemployment, whatever. So you had this sort of systematic leaning against the appreciation of their currencies. And in the advanced market economies, it showed up as sort of mirroring the kind of policies that the Fed was following, responding to decimal point deviations in inflation from targets. And in the emerging market economies, it was more a question of sort of direct intervention in the foreign exchange markets, and also monetary policy that was easier than it would otherwise have been. And so, we find ourselves today now with this huge expansion in the balance sheets of central banks, in most of the big countries. So we have these central banks holding large amounts of their own government's securities. But in addition, we have sort of finance ministries and central banks and sovereign wealth funds holding huge amounts of other countries' government securities. And somehow the idea that you've got this confluence of massive expansion in the holdings of government assets by central banks or institutions related to central banks, I don't like it. nothing really bad has happened up until now, but you sort of look at what's happened because there's been no discipline sort of saying to people, you can't do that. I'm worried about this going forward because I think in the end, it's the international monetary system that's sort of key to things in an increasingly globalized world.
So that's where I want to actually go. I want to mention a couple of books for our listeners that have been helpful for me in thinking about the interwar period and this beggar thy neighbor policies as historical facts of history and helping me think about where we might be going. One of them is Barry Eichengreen's Golden Fetters. Dr. Eichengreen was, of course, on Hidden Forces many episodes ago for a conversation about currency and the Great Moderation and things like this, but also Charles Kindleberger's The World in Depression. Very, very valuable book for me. Yeah. I'd love to dig in a little deeper here about what might be, a way of talking about currency wars and the problem of these floating exchange rate systems and where we go from here. You actually have a quote. I have it here in my rundown. You write, "Every major country is engaged in currency wars, even though they insist that QE has nothing to do with competitive depreciation. They have all been playing the game except for China so far, and it's a zero-sum game. China could really up the ante." China's a really interesting variable in today's world. And talking about this complex dynamic system, China was in a very different place, and this was a very different world politically and also economically in the last crisis period. What is your thought about China and its role in the international financial system as it is today and in whatever sort of might potentially emerge either deliberately through cooperation internationally, which seems increasingly difficult today, or organically perhaps, and we can talk about what that might look like?
Well, certainly at the moment, China has become so important in the international trading system and the financial system that it absolutely cannot be ignored. And of course, you remember a little while ago that when the renminbi went through 7 renminbi to the
peg
dollar, that there was a lot of concern that somehow we were going to get into competitive, depreciation, that the Fed might then respond with intervention. My concern was that, if any of that happened, that it might actually bring to the fore concerns that people ought to have had about the potential inflationary implications of all of this stuff. But in the event,
what do you mean when you say the potential inflationary implications of all of this stuff? What do you mean?
What I mean is, we've had sort of willy-nilly a big expansion in government debt in many places, and at the same time, a significant financing of that from central banks. And Japan, I guess, is the most extreme example, but others are not a million miles behind. What we know from history is that you can do this for a long period of time. You can run government deficits and run up the government debt, and the central bank can finance it, so long as the markets are of the view that the governments will eventually sort this thing out in a non-inflationary way, that they'll eventually go back to more prudent, sustainable fiscal policies. But what often happens is that the continued recourse to the central bank basically causes that expectation, eventual sanity, basically causes that expectation to dissipate. And once people start to feel that we're actually on a route here of fiscal dominance and central bank financing, then the reaction is, I'm out of here. And we've seen this so many times before. Just think Latin America or, many, many other countries and other places. The confidence dissipates and the game is over in a highly nonlinear way. Everything has been fine up until now, including in Japan. But well, the old joke about the guy that falls from the 22nd story window?
I do.
Yeah. Yeah.
But please say it. I've heard it from you.
For your listeners, as he goes past the second story, someone shouts out, "How are you doing?" And he says, "So far, so good." So the world is a highly nonlinear place. And because everything is fine up until now, everything will continue to be fine, is just, I believe, false.
Not every floor, not every story is made equal.
Yeah.
There's a big difference between going from 50 to 49 and from 1 to 0.
Yeah.
So what you're talking about is the path to inflation. And this is something that I've grappled with a lot because on the one hand, we have a path for deflation. We've seen it. It's what others refer to as Japanification. Japan has seen the capacity to grow its public sector enormously without being able to generate inflation. It's suffered under many of the similar forces that we're experiencing today, demographics, debt, etc. So that's something I'd love to continue to discuss with you. I'd also want to go deeper into this point about the international monetary system and maybe explore two possible paths. One, which would be an international monetary system more along the lines of Bretton Woods, not necessarily in terms of the gold standard or any particular restraint, but simply a deliberately architected one, versus perhaps something that would emerge organically. And I'm thinking, of course, a recent example of Libra, which attempted to step into the breach and provide, let's say, a non-sovereign currency that companies would be able to use and people would be able to use. We're going to discuss all of that in the overtime. Dr. White, please stick around. For our regular listeners, you know the drill. If you're new to the show, or if you have not yet subscribed to our Patreon subscription, I suggest you head over to patreon.com/hidden forces, where you can access the audio file, autodidact, or super nerd tiers, which give you access to the overtime that I'm about to have with Dr. William White, as well as the transcript to our conversation, as well as all of my notes, which are exceptional today. I'm also going to provide PDFs of articles and papers written by Dr. White that I relied on for this conversation. Bill, thank you so much for being on the program, and please stick around for the overtime.
Well, thank you very much, Demetri. I've really enjoyed it, and I've also enjoyed being introduced to Hidden Forces. So thank you very much.
Today's episode of Hidden Forces was recorded at Creative Media Design Studio in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/hidden forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.